If you are self-employed, maybe a consultant, designer, coach, or contractor, the new Big Beautiful Tax Bill should change the rules for you. I'm going to break down exactly what that law means for your business income, your write-up, and your 2025 tax return. By the end of this video, you will know how to plan your deduction, time your purchases, and set up 2026 so your tax works for you, not against you. Let's start with what changed. The July 2025 One Big Beautiful Act, also known as Beautiful Bill, updated a lot of sections of the tax code. And for Schedule C owner, solo entrepreneur, 5 changes stand out. First, the qualified business income deduction. So that's the 20% deduction that you get on your self-employed profit is now permanent. Yay! Before that, it was set to expire. Now it's part of the permanent tax code. That means you can plan your business around it. It's not temporary bonus anymore. It's your built-in tax reduction. Let's make it real. If your business net $120K after expenses, 20% of that, which is $24K, may be deductible, but you don't have to beg Congress for an extension every year. It's there, it's permanent. The permanence of QBI changes how you think about planning. You can now project income over several years and structure your expenses strategically. Second, 100% bonus depreciation is back. It applies to qualified property acquired after January 2025 and placed in service during the eligible window. Placed in service simply means ready and available for business use. So, if you buy a new computer, a camera, or a work van after January 20th, 2025, and you start using it in your business the same year, you may deduct the entire cost upfront instead of depreciating over 5 years. Example, you buy an $8,000 workstation in February 10, 2026. You start using it the same day, you can take the whole $8,000 as a deduction. That's a direct, immediate reduction of taxable income. This one change alone can smooth your cash flow if you plan your big purchases correctly. Third, domestic R&D expensing is back. If you create, improve, or develop something new in the United States, like software, tools, digital products, or internal system, you can expense the cost now instead of amortizing over years. For service businesses, this is huge. You don't have to be a tech company to benefit. If you are building an internal automation tool, a new app, or even improving how your online course deliver content, that may count as R&D if it's developed here in the US. Example, you pay a US developer $6,000 to build a client portal. That's a domestic R&D expense. Document it with invoices and time logs, and you might get the full deduction in the year it's spent. We will go over exactly how to document the cost later, but remember, location and record keeping matters. Let's talk about point number 4. So, business interest deduction relief. The Big Beautiful Bill make EBITDA a standard permanent for Section 163J. Translation, plain English please. If you finance equipment, a van, or even larger projects, more of your interest may now be deductible because the limit is based on earning before interest, taxes, depreciation, and amortization, not the tighter EBIT standard. So, finance growth, when structured properly, can actually become more tax efficient. Fifth, a small but useful update. The threshold for certain information returns like Form 1099 NEG, 1099 MIS go up starting in 2026. That means less red tape for some small payments. You will still track everything in 25, but your compliance gets a little easier after that. Translation, so that's the technical list. So now let's talk about what all of this means for you, the Schedule C service provider trying to plan ahead. Before this bill, most of the best tax perks favor manufacturer and product-based businesses. Now, service providers are finally included in the conversation. If you make your money from idea designing, consulting, trades, or digital work, this is how you get the benefit. So QBI give you the consistent 20% deduction baseline, and then bonus depreciation give you the instant write-off for tech tools. Domestic R&D expensing reward your innovation. Interest deduction relief give you breathing room if you use financing. Together, this creates a tax environment where the planning beats panic. So let's put it all together with some stories so you can visualize how this play out in your world. So Sasha running a solo brand consulting business in Seattle. Her 2025 profit is projected at $150K. In December, she ordered $10K worth of new design equipment and software, but doesn't set it up until late January 26. That's her play in service date, which is January 28, 2026. So you see the difference between when you bought the product and when you actually place in service, right? Because you have to go by that date when you actually place it in service and using it. Because not actually technically using it, but available to use. So it have to be all set up, installed, that kind of thing. Because of the new bonus depreciation rule, she can deduct the full $10K in her 26 return. She also decides to build a proprietary client dashboard using a US developer, costing $5,000 plus her own time. So she locks the hour, keep invoices, and take the deduction for domestic R&D. In 2 moves, bonus depreciation and R&D expensing, she lowered her taxable income and set up better tools for her business. That's the power of timing. It's not about buying more, it's about buying strategically. Let's talk another story. Troy the contractor. So Troy runs a home repair business in Phoenix. He expects $280K profit in 25. He plans to finance a $40K van and $10K in tools in March 26. Because of Section 163J now use EBITDA permanently, more of his interest on that loan is deductible. He also hired a part-time helper mid-year, which adds wages that may help him preserve the QBI deduction, and his income climbs into the phased-out range. His accountant ran a projection showing that timing his financing and hiring together saved him overnight grade in taxes compared to doing both in separate years. When you line up purchases, financing, and staffing with the new rules, you don't just save, you create flexibility. Now let's talk story number 3, Lena, the coach. So Lena is an online coach and course creator based in Atlanta. She expected $120K in 2025 profit. In early 2026, she invested $8,000 in professional video gears and started using it right away. So that's full bonus depreciation. She also hired a US developer for $20,000 to build a membership platform. She documents all hours, invoices, and location data to support the domestic R&D deduction. By stacking QBI, bonus depreciation, and R&D expensing, she keeps roughly $12K more in her pocket in 2026. These stories show that tax planning isn't about spending money. It's about timing and documentation. Now let's turn this into an action plan for your 2025 tax year filing. Step 1, project your profit early. So run your year-to-date profit and losses now. Estimate 2 numbers, a conservative profit and a stretchful profit. So know the range help you plan QBI eligibility and see if you cross any threshold. Step 2, list your asset and place in service dates. Create a simple table, item, cost, purchase date, place in service date, business use percentage. If something is still in a box, it's not yet placed in service, meaning no deduction and you start using it. Step 3, track domestic R&D costs properly. Add expense category in your bookkeeping software, like US software development, US process improvement, or US prototyping. Keep time logs invoices, and contractor addresses to providing work as done in the US. Step 4. Review QBI limitation. Check whether your business type is considered a specific business. If you are near income phase out, you can defer invoices or add deductible expenses to stay within this limit. Step 5. Use retirement and health plans as levers. For example, SEP IRA, solo 401k, and HSAs can reduce your taxable income while building long-term savings. These also help maintain QBI eligibility. Step 6. Plan financing strategically. If you are taking a loan for equipment, separate your interest from principal in your records. Under the new EBITDA rule, that interest deduction matters. Step 7. Prepare vendor records for next year 1099 changes. You want to collect W-9s before paying contractors. This keeps you ready in the 2026 threshold changes. Step 8. Schedule a December mini close. So block out an hour on December 1st. Review invoices, plan purchases, and hiring decisions. Ask yourself, should you invoice this client now or in January? Should you buy this gear now or wait? Step 9. Consider your entity for 2026. If your profits are consistently above 250K, talk to your advisor about whether an S election makes sense in 2026. The big beautiful tax bill makes QBI permanent, but S-corp structure can serve as saving depending on payroll and benefits. Each of these steps build control, and control is what turns tax season from panic into power. Now let's look beyond 2025. So we have a couple of pillars here to save your taxes, right? So pillar number 1 is to make QBI part of your forecast. So treat it as a permanent line on your financial plan. You want to project your quarterly profit for 26 and 27 as a QBI estimate roll at 20% of your qualified income. Update each quarter so you can adjust expenses or hiring early. Pillar 2. Time your capital purchases. If 2026 will be a high income year, placing new equipment and service early in 2026 will offset that spike. If 2025 is your high year, place gear before year end to reduce that bill. Pillar 3. Keep building in the US. If you outsource, consider shifting key development back to US contractor so your work qualify for domestic R&D expensing. Document everything: who did this work, where, and when. Pillar 4. Use financing wisely. Pair EBITDA interest deduction with bonus depreciation. If you are buying large equipment, line up financing before year end so your payment and deduction line up cleanly. Pillar 5. Review your entity each fall. Run the number comparing Schedule C, Schedule S every November. You can answer can change as your income grows. Pillar 6. Keep quarterly checkpoints. Add 4 recurring events to your calendar. So quarter 1, profit projection. Quarter 2, equipment reviews. Quarter 3, R&D documentation check. Quarter 4, entity and strategy review. With a rhythm like that, you never scramble again. Here are some tips. First, you want to think about audit proofing, so you think about documentation. So audit proofing doesn't have to be scary. For bonus depreciation, keep the invoice, proof of payment, delivery confirmation, and a note of photo showing the ready for use date. For domestic R&D, keep a one-page summary of each project: purpose, US personnel, days, task, cost, location. For finance assets, keep the loan agreement, amortization schedule, and interest records separately in your book. Store everything in one folder. You can call it TOB3 support. And then inside, create subfolder like bonus depreciation, R&D, US, financing, or drop PDF ins and you go. That folder is your insurance policy if there are ever asked questions. Some common pitfalls and fixes. So pitfall number 1, confusing invoice date with place in service date. For the fixed, you wanna write PIS, month, date, year on each asset, record the day you start using it. Pitfall number 2, mixing personal and business use. The fixed, you want to keep a simple log for mixed use item like camera or vehicle and apply a reasonable business use percentage. Pitfall number 3, combining offshore and U.S. development. The fixed, use separate vendor tag for domestic work and foreign work. Pitfall number 4, ignoring interest tracking. Fixed, add a dedicated interest expense account in your chart account. Avoiding these small mistakes can protect thousands in deductions. Let's lock in your next step. Run your 2-scenario profit projection. Build your asset table with place and service date. Action 3, create your U.S. R&D tracking sheet and log the last 30 days of development work. Action 4, add tax in your accounting software like bonus, depreciation, post 11/20/25, and R&D US. Action 5, schedule your December mini close and your November entity review on your calendar today. Once the 5 actions are done, you will be operating from a plan, not reacting to surprises. The Big Beautiful Bill didn't create a brand new services deduction, but it did something even better. It made your QBI deduction permanent, brought back 100% bonus depreciation, restored domestic R&D expensing, and gave small business breathing room with interest deduction and 1099 rules. That combination made 2025 and 2026 the most powerful planning years we have seen in a long time for solo service-based business owners. So use this window, plan your purchases, document your bills, forecast your profit, and walk into 2026 knowing you are ahead of the curve. If you found this helpful, hit like, subscribe for more beautiful bill updates, and share this video with another small business owner who needs the tips. I will see you in the next episode of our Beautiful Bill series, where we'll tackle the new Schedule C energy credit update for 2025.